Hello, this is Guan Invest. So today I'll be talking about a few things. So I'll be talking about the Chinese stock market rally, Singapore REITs market, as well as Singapore bank stocks. So let's cover the first one first, which is the Chinese stock market. So the Chinese stock market is basically up around 20% year to date. Alibaba in the past month alone is up more than 60%. That is just incredible. That is 6 years of returns in just 1 month. And do I think this is rational? No, I don't think this is rational. I think everyone is FOMOing into Chinese stocks again, like they did back in the day. I don't think this run is sustainable. It all started because of this DeepSeek event. So if you look at Alibaba stock, right? Alibaba was trading at an 11 PE a month ago. Now it is trading at a 22 or 23 PE. Is that jump in valuation justifiable? Did anything fundamentally change that spurred Alibaba into trading now at a 23 PE, a PE that is higher than Google? I don't think so. So the problem with all these Chinese stocks, right, is the government. Because if the government introduce a stimulus tomorrow that is disappointing, then the stocks will all crash. If the government tomorrow say that all these tech stocks, all these tech companies, they cannot operate in the US, then the stock's gonna crash again. So the government is very volatile. The government is one of the key problems from my viewpoint in investing in all these Chinese firms. So that's why I haven't been really investing in all these Chinese firms. Maybe I'll do so in the future because there are some incredibly valued stocks over there, like your Anta. I think Alibaba, Baidu is trading at basically liquidation value, I think a month back. Yeah, but all these companies, they all have one common problem, which is the volatile Chinese government, which I'm not comfortable investing in. I think the maximum allocation that you can put into Chinese stocks, right, is maybe around 10%. I don't feel comfortable going above 10% of my entire portfolio putting into Chinese stocks because of the government. So hopefully it comes back down again and then I get another chance. But yeah, that's about it. Next one that I'll be talking about is Singapore REIT stocks. So Singapore REIT stocks have been hammered for the past 2 years or so because the 10-year yield in the US has been going up and up and up ever since the Fed started raising rates. So is it time to buy all these REIT stocks now? So the problem with all these REITs, right, is they have one thing in common. I have a lot of REITs, but they have one thing in common, which is they are reliant on the US cutting rates for the stocks to move up, for their net income to go up. Because all these real estate companies, they are basically trading like commodity stocks. They're buying real estate, and real estate in itself is a commodity as well because there's no IP, there's no moat, there's no business quality for all these REITs. And the models are all the same. They basically just they buy properties, they rent it, and then they give you back the income as dividend, and then they dilute shareholders so that they can buy more properties again, and then they just recycle this over again. So I think for all the REITs in Singapore, the problem with them is there isn't a very high quality REIT. I mean, sure, you have your Fraser Centrepoint Trust, you have your CICT that owns the different offices, the different malls in Singapore, which are very popular. But the problem with all these REIT stocks is they don't have the business quality that some of your other US companies have. So I actually have quite a substantial amount of my portfolio in REITs now, around 10% or so. But the problem with all these REITs, right, is they have a high dividend yield, yes, but they are of low quality. So when it trades back up to fair value or maybe slightly overvalue again, I'll be looking to get out of all these REIT stocks. I want high quality companies in my portfolio. And yeah, there are some good deals now in the REITs market, but they are not high quality. And I rather have my companies that are high quality as compared to REITs paying me 7% dividend yield every year. Next topic, so your Singapore banks. So all your Singapore banks, your DBS, your OCBC, your UOB, they are trading at historical high valuation. So DBS itself is trading at around a 1.9 price to book. That's higher than your Goldman Sachs in the US. And then you have your OCBC as well, it's trading at a 1.5 price to book. And then UOB is somewhere there as well. So the problem with all these banks is not the business itself. DBS is an incredible business. They have their net interest income business. They have their investment plans business and all that. And the business itself, the trust that they have with the public is incredibly strong. But the problem with all these bank stocks, right, is they are trading at a very high valuation. So for example, DBS, as I said earlier, is trading at 1.9 price to book. Normally you want your banks to be closer to 1 or to 1.5 in DBS case. But now they're trading at a 1.9 price to book, and I think for its current growth prospects, it is not a justifiable valuation. It is a valuation that is almost priced for perfection. So if the Fed starts to cut rates, I calculated, so if the Fed cut rates to around 3%, DBS will lose around 10% of its net income, net interest income. So if you take away 10% of the net interest income, then if the stock price contract as well, so whenever your stock earnings, right, they drop, the stock price will drop even more. So you can somehow see that if the Fed cut rates to around 3%, then DBS stock will crash maybe around 20% or so already. So 20% downside, if it cuts to around 3%, which is very possible in the next 2 years. Of course, no one knows where this macro environment will go. It is very arbitrary, it is very random, but it is better for the Fed to have a less restrictive interest rate environment. So it is more likely that they will cut interest rates when possible instead of raising it. Unless they really have to raise it, then they will raise it. But if they raise it, then a worldwide crisis will happen. So if the Fed cut rates to 3%, DBS will lose 10% of its income, and 10% of its income will translate to around 20% downside in the stock right now. So that's around $35 or so, and that will be likely my buy entry for DBS stock. So hopefully it gets there. I'll liquidate my entire Singapore stock portfolio and then put it all into DBS because it is a very high quality business. It is the only business in Singapore that I have confidence in.